You just started freelancing and you keep hearing about solo 401k and SEP IRA. But what are they actually? And which one should you open first? If you're confused, you're not alone. These accounts have weird names and complicated rules. But here's the good news. By the end of this video, you'll understand exactly what each one does and which is right for your situation. Note: this guide applies to US-based freelancers and self-employed individuals. Welcome to the Freelancer's Wealth Blueprint. I'm going to break this down in plain English. No jargon, no confusion. Let's start from the very beginning. First, why do freelancers even need special retirement accounts? When you have a regular job, your employer often offers a 401k. They might even match your contributions. Free money. As a freelancer, you don't have an employer, so you don't get that benefit. But here's what most new freelancers don't realize. You can create your own retirement account that gives you the same tax advantages, sometimes even better ones. That's where solo 401k and SEP IRA come in. They're retirement accounts designed specifically for self-employed people. Let me explain what each one is in simple terms. A SEP IRA stands for Simplified Employee Pension Individual Retirement Account. Don't worry about the name. Just think of it as a supersized IRA for freelancers. A regular IRA lets you contribute about $7,000 per year. A SEP IRA lets you contribute up to $72,000 per year in 2026. That's a massive difference. A solo 401k is basically a 401k plan where you're both the employer and the employee. It's also called an individual 401k or self-employed 401k. Same thing, different names. It also lets you contribute up to $72,000 per year. So if both have the same maximum, what's the difference? Here's the key difference that matters. With a SEP IRA, your contribution is limited to 25% of your net self-employment income. So if you make $50,000, your maximum contribution is $12,500. With a solo 401k, you can contribute as an employee first, up to $24,500 in 2026. Then you can add another 25% on top as the employer portion. Let me show you with real numbers. Say you're a freelance writer making $50,000 per year. With a SEP IRA, 25% of $50,000 equals $12,500 maximum. With a solo 401k, $24,500 employee contribution plus roughly $9,200 employer contribution. That's about $33,700 total. At $50,000 income, the solo 401k lets you save almost 3 times more than the SEP IRA. Why does this matter? Because every dollar you contribute reduces your taxes. If you're in the 22% tax bracket, that extra $21,000 in contributions saves you over $4,600 in taxes. Now let me tell you about 2 other differences beginners should know. Difference number 1, the Roth option. With a SEP IRA, all contributions are traditional. That means you get a tax break now, but you pay taxes when you withdraw in retirement. With a solo 401k, you can choose Roth contributions. You pay taxes now, but your money grows tax-free forever. When you retire, you pay 0 taxes on withdrawals. If you think tax rates will be higher in the future or you're in a low tax bracket now, Roth can be incredibly valuable. Only the solo 401k offers this choice. Difference number 2, borrowing from your account. Life happens. Sometimes you need cash. With a SEP IRA, you cannot borrow from it. If you withdraw early, you pay taxes plus a 10% penalty. With a solo 401k, you can borrow up to $50,000 from yourself. You pay the interest back to your own account. As long as you repay within 5 years, no penalty. This flexibility can be a lifesaver for freelancers with unpredictable income. So the solo 401k sounds better, right? It usually is. But there's one thing the SEP IRA does better. The SEP IRA is incredibly simple. You can open one online in 15 minutes. Go to Fidelity, Schwab, or Vanguard. Fill out a form. Done. No paperwork, no annual filings, nothing. The solo 401k takes a bit more effort. Setup is still free, but you need to choose a plan document. And once your balance exceeds $250,000, you have to file a form with the IRS each year. It's called Form 5500-EZ. It's not hard, but it's an extra step. If you just want the easiest possible option to get started, the SEP IRA wins. So which should you choose? Here's my simple framework for beginners. Choose the SEP IRA if you're making under $40,000 and want the easiest setup. At lower incomes, the contribution difference is smaller, so simplicity might matter more. Choose the solo 401k if you're making $40,000 or more and want to maximize savings. If you want the Roth option. If you value the ability to take a loan. Or if you're willing to handle a little extra paperwork. For most freelancers, I recommend the solo 401k. The extra contribution room adds up to hundreds of thousands of dollars over a career. Now let me answer the questions beginners ask most. Question 1. Can I have both? Yes, but your total contributions across all accounts are limited. There's rarely a reason to have both. Pick one. Question 2. When do I need to open it? You can open a solo 401k anytime during the year, but employee contributions must be made by December 31st. A SEP IRA can be opened and funded up until your tax filing deadline, including extensions. If it's late in the year and you haven't done anything, a SEP IRA gives you more time. Question 3. Where should I open one? Fidelity, Schwab, and Vanguard all offer both accounts for free. No fees to open, no annual fees. I'd go with whichever you already use, or Fidelity if you're starting fresh. Their solo 401k also allows Roth contributions. Question 4. How much should I actually contribute? Start with what you can afford. Even $500 per month makes a huge difference over time. $500 per month for 30 years at 7% growth becomes over $580,000. The key is to start. You can always increase contributions later. Here's your action plan. Step 1. Decide which account fits your situation. SEP IRA for maximum simplicity. Solo 401k for maximum savings and flexibility. Step 2. Open the account. Go to Fidelity, Schwab, or Vanguard. It's free. Follow the prompts. Step 3. Set up automatic contributions. Even a small amount each month builds the habit. Step 4. Invest in a simple target date fund or total market index fund. Don't overthink it. Step 5. Increase contributions whenever your income grows. That's it. You now understand the two most powerful retirement accounts for freelancers. The biggest mistake is doing nothing. Every year you wait costs you thousands in tax savings and decades of compound growth. Pick one. Open it. Start contributing. Your future self will thank you. If this was helpful, subscribe for more freelance finance content. I break down complex topics into simple action steps every week. As always, this is educational content, not financial advice. Talk to a tax professional about your specific situation. See you in the next one.